Hello, good evening, guys. Welcome to our lesson on technical analysis and technical trading. So today I will be giving us a concept about how the forex market works, the structure of the forex market, the market session timings, then the formations for us to enter in order to confirm our trade for a buy or a sell. Then finally the ADR, that is the average daily range, the average daily range. Alright, so it won't be a long video. We'll just dive down straight into the lesson of today. Now, first of all, the forex market, the foreign exchange market, every day moves in about 3 sessions. The foreign exchange market moves in about 3 sessions, and let me show you right here the main ones. So you have what? The London session, then followed by what? The New York session, then finally the Sydney and Tokyo session. These sessions, they overlap a lot, Sydney and Tokyo, so we just call it the Asian section because Sydney and Tokyo are under the Asian hemisphere of the world and all that you get. So the London session, Sydney and Tokyo. Now if you look at the GMT time here, you see that our day begins from the Asian sessions and ends with the Asian session. So in between we have what? The London and the New York session. Now, how does this play on the foreign exchange market chart? How does this play on the chart? I've marked out these things for you right here. So at the beginning of the day we have what? The Asian session. It ends the day and it begins the day, and usually this session is in consolidation. That is, at the Asian session there is no much volatility in the markets. It's one of the lowest times to trade in the forex markets. So therefore the graph, the candles tend to be very short. Its form of ranges goes up and down, tiny movement, about 10, 15, maximum 20 pips sometimes. So this is how the day begins, and like I said, around 22 o'clock GMT to about 7 o'clock in the morning. After that it is followed by what? The London session. The London session is when the London market open, the stock markets and all that. So there is increased volatility because of increased trading activities down there in that session. It begins from around 8 o'clock down to about 14 o'clock in the 16 o'clock in the afternoon. Then it directly overlaps with the New York session. This blue box here is the New York session. So London session overlaps with New York session. So New York session begins about 13 o'clock as 1 p.m. GMT to about 9 p.m. GMT also. So this is what happens every day, and the chart behaves accordingly. The currency chart behaves accordingly. It happens in every pair. Right now we are using a GBP USD pair. It happens in every pair, similar patterns every day. So with that in mind, we go to the next thing. Now, after the Asian session, we have a low volatility. The the London session is followed by increased trading activities. So usually a breakout. Then, as soon as the New York session comes on, the market usually reverses. So you see what happens here? New Asian session consolidation. London session breakout. It broke out from this range. It broke out down. Then so what happens at the beginning of the New York session, boom, a reversal, pulled up, and ended the day with a consolidation again, another Asian, and so on and so forth, and the rest. It's a cycle over and over again. Now, how do we use this for trading? So you know the time of the day for you to enter a trade, you know, whereby you will get the most movement of the candles in your favor. Alright, so with that out of the way, I will go down to the ADR concept. The ADR concept is the average daily range. It talks about how far in points a currency pair can move throughout the day. Now look at this. Don't forget we are using a 15 minutes time frame. And this marker here, this straight line here, shows the end of a day to the beginning of a new day. Down to here, this other marker here, it shows the end of a day to the beginning of a new day. So if you don't have it on your chart, please put it there, because since we trade intraday, that we trade within a day, you ought to know when the day ends and when the day begins, so that you can know how to use the market sessions, the various market sessions, to your advantage to place trades. Just for notes. Alright, so I was talking about the ADR. It shows you how far in points the market moves. Usually the currency pairs on the forex market, and most times every other form of indices or financial instrument, has a determined number of points in pips it can move a day, and I'm going to show you how to calculate it. There are two ways to do this. The first way, I call it the manual way. You can just get that straight from the chart. So now, the highest points, guys, look at this market here now, June 30th. The highest point of this market movement today was somewhere here. You can see that, right? About 1.23986 the price. The lowest point of the market for the day was somewhere about here, about 22604. So how do we calculate the ADR? Like I mentioned, you get the difference between these points from here to here for a week. Talking about doing this manually for a week, let's say 5 days, Monday to Friday, sum it up and you get the average. In other words, the movement to the points on Mondays, Tuesdays, Wednesdays, Thursdays, Fridays, sum it up together, divided by 5, that's the average. Then that's what will give you the ADR. So it shows you how far the market has moved. So you need to know this so that you don't just jump to the market when the market has moved far, maybe already exhausted with ADR. Just imagine the market has moved from here to somewhere here, and you jumped in here thinking the market is going to reverse because you see something like an M here. You're going to lose that because it has already exhausted its ADR, so it won't expect much movement at that point again. So it's not going to come down because this ADR was exhausted late in the day. If the ADR happens early in the day, maybe during the London or the Asian session before the New York session, then you can get it because it's going to reverse back in the charts. But if it happens late in the day, you may not get much reversals. It's 50-50. It's much more risky to jump in because you may not get what you're expecting in order to trade the reversal of the market for that day. Alright, so now calculating the ADR, let me show you that manually. Let's pick a week from the charts here. Let's begin from on the 22nd, right? Because here you have on the 19th, so the new week began here 22nd. So this is a Monday, so we're gonna get this. The lowest of the market here, the price reading was 1.23363, and the highest is what, 1.24744. Now let's put this down in our calculator. Where's my calculator? Okay, let me get that here. Calculator. Alright, so that, what was that? Let's go back there. So June 22nd, yes, the 22nd. The highest for the day, was the highest point on the market. The price was at what, 1.24765. So you put down there in a calculator, open a bracket, 1.24765 minus the lowest point of the price for that day. The lowest point of the price for that day is at, on June 22nd, 1.23383. okay, so you put that down, minus 1.23383, close the brackets. That is for a Monday. Don't forget we are adding it up, so add up for Tuesday. On Tuesday, calculating the ADR manually, 22nd, the highest of the day for the market's price is what, 1.25302. So put that down, 1.25302 plus, minus, subtracted from the lowest price the market moved for that day. That's about somewhere here. That's on the 23rd of June, Tuesday. That's about 1.24319. 1.24319. We put that down there, minus 1.24319. Then we calculate for Wednesday. Alright, Wednesday, June 24th, the highest point the market moved for the day was about 1.25412 in price, 1.25412 in price, minus the lowest point for the price on June 24th, on the Wednesday, is here. That is what, 1.24141. okay, so we put it there as in our calculator, 1.24141. then we go for Thursday plus the next value for Thursday, June 25th. The highest point of the price is what, 1.24605. okay, put that down, 1.24605 minus the lowest point the market moved, the lowest point the market moved on June 25th is at about here. This is the lowest point for the day. This is the highest point the market got to. This is the lowest point. This is about 1.23952. So 1.23952. Close that out. That makes for Thursday. Then on Friday, plus the point move on Friday, All those individual brackets, if you subtract them, you get the number of points moved in the market you get. So it will give you a summary of Friday 26th. The highest point of the market is 1.24365. okay, so put it down there, 1.24365 minus the lowest point the market moved on June 26th. On Friday, the lowest point is at where? Here, which is 1.23180. okay, so you put down there your calculator, 1.23180. so close the bracket, and what does this give you? It gives you what? 0.05474. Don't forget, we always deal with the last digit, the last 3 to 4 digits. So this invariably becomes what? 5474. So 5474. Now divided by 5 to get the average. Talking about 5 days, right? So that is equivalent to what? 1094.8. So this is the number of points the market moves average on the pair GBP USD. So on average, you're expecting a maximum movement of points for this pair to be about what? 1098.8. so it could be, this is just a rough estimate, manually calculation. So it could be 900, it could be 1,200, 1,500, but it's about that 1,000 points. It's an estimation. It's not an exact or absolute value. So it tells you how far the market has moved. So if it has moved these points, then you know what to do to use it to trade to your advantage. I'm going to show you how to do that in the video. Okay, now let's proceed. So I think you saw something here. You saw these blue markers, right, and this other blue. Now into the market sessions, I told you earlier, you see them here. We have the Asian session, the London session follows it, then the New York sessions. And you know what happens? The Asian is a consolidation, the London is a breakout from that range, from that consolidation. Then the New York session is what? It's a reversal of that direction that it broke out from. So it was going down here, the New York session came up, they overlapped, bam, a reversal, and it went the other way up. So if you know what happens like this, you're able to know how to place your trade, when to place your trade, and at what point using the ADR. Now if you look at it very well, the ADR for this market was not met until towards the end of the market, towards the New York session. You see this? Okay, so let me show you how we can use this. Now in order to know where to jump in a trade, there is usually an M formation, as you can see here, or a W formation, as you can see here, depending on if it was selling or buying at the start of the market trading day. Alright, so the W usually forms when the market breaks out from the Asian consolidation, the the London session breaks out with a sell. As soon as the New York session happens, it usually reverses up the opposite way. You get why the M formation happens when the market breaks with a buy, and reverses up, reverses down the opposite way. Now whether it will be An M or a W depends on the trend. Depends on the trend of the market on a larger time frame. Now look at what is happening here. Let me switch to the H4 time frame. Okay, let's go to the daily time frame. This is how you also analyze charts. On a daily time frame, you can see that the pair GBP/USD is in a range. It is not moving up in direction, it is not moving down in direction. It's just going up and down, bouncing up and down, bouncing up and down. So you know that when the market is somewhere here, based on the previous history of this point and this point, it's gonna do what's gonna bounce up again. And when it gets to here, based on the previous history of this point and this point, it's gonna do what? It's gonna bounce back down again. So now at this point where we marked our M and W signs, you can see that at this point here, it's similar to the region of both here and here. So there was a short bounce up again in the consolidation, then followed by a short bounce down and a short bounce up. So you know that okay, it's a ranging market. I'm gonna follow it as it's bouncing. Now let's go down to the H4 time frame. So after the daily time frame, go to the H4 time frame, you can see it much more clearer. So you get it much more clearer. So it is much more sharper. The candles are more smaller, so you see more of the movements in the market. So you say okay, now the market for this day, for this week, because on the H4 time frame the markers show you a week. So from this marker to the next marker, this black marker here, it's a week. So we say that from the week began with a buy. The week began with a buy. So on that day where we marked blue, you know what to take as a trade. We can see that in M15 time frame. Now we know okay, the week began as a buy, so it's a buy trend. It's a short buy because it's a ranging market. So what happened? There was a W. You take it, and once you see the W formation starts, first candle, second candle, place your buy here. And what happens? The market moves up in your direction. So what happens? Then also it got to the high of the week. The high of the week. Let me mark this for you and show this to you on a much more higher time frame. Now look at the point it got to here. Right now it reversed with an M. Why is this so? If you go on a higher time frame back to H4, you saw what happened. Let's go back to D1. So what happened? At that point where we marked, where it reversed, if you look at the previous history of the chart, that is the point whereby reversals happened, where it got to and sold down. So therefore we expected the same to have to happen at that same price line. You get, using that same price line, it sold down, as you can see clearly. That is why on that day, back to 15-minute charts, on days like this, I know that okay, I'm not going to look for a W formation, I'm going to look for an M formation. And what happened? When you see the M, you're going for a sell, and boom, the market follows the direction, you make money. So you look at it, first candle, second candle, third candle, you are in already, goes down somewhere here, you are out of the market, and you're okay for the day. 300 to 500 points, and you are good. Now the market will not just move straight down like an arrow. No, after it's technical, it's going to move in a pattern. Now see what happens here. I'm going to show you this in the screenshot here. Okay, let me have the screenshot. Then look at what I'm saying here. So the market will not just move down like this because it's one M here. I'm not just move straight down like this. No, it doesn't happen that way. The market, many times we do this. It's gonna go like this, come back a little like this, come back a little, test the previous level, then like that, just on and so forth. So even though you see an L formation is somewhere here, you don't expect market just go down like this straight and boom. No, it's gonna go down in a pattern like this. And this short pullbacks it have is because it's trying to test certain points. For example, here and here. So the first pullback touched our line on the chart. That's why it's good for you to have an idea of chart lines, because it's an algorithm. The market moves with an algorithm also, despite the many influential factors. So there's a pattern it follows. And when you see this, you know, okay, yes, this one I'm gonna do. So you don't expect me to go a straight movement down the charts like that. So let's go back to our chart. Yes, so that's what happens basically. You get now. So you know the ADR and the rest. Now for example, now look at what happened. Let me pick today. Look at what happened today. Because of our higher time frame, we know that okay, yes, the market has reached a point where it bounced up again. This point here where it bounced up for a buy is the same point somewhere here and here and here is close to it. So not okay, if we get to that point, the mirror effect takes place. I will explain more in the PDF. The mirror effect is whereby the market behaves as a previous history of what has happened before. So it came down here, it bought, went up, came down here because of this similar thing that it bought also. It came down a little bit further, but it bought, and now came down, bought, came down, bought. So the mirror effect, it does what it has done before, mirroring itself. So now okay, we're looking for a buy trade. So any trade we place for the day will be a buy. But on the time frame, it actually exhausted the ADR. How? Let's see. Look at it. The highest point of the day is what? 1.24859. So let's see in our calculator. 1.24859 minus the lowest point for the day is at where? Is the lowest point of the day is at what? 1.23591. 1.2323591. And what is the value? Let's take the last four digits. 1262, about 1262. And what was our previous value of our ADR? It was what? 1094. So you saw that the market moved its complete ADR for the day. It's not really the market is going to move its complete ADR. Some days it just ranges, it just consolidates. So just imagine jumping in to take a sell somewhere here. You are not going to get anything much because it's late and no much revival. Even though you saw the M formation here, you might not get anything much at all. But since you know that okay, this was a buy trend, so therefore you are looking for a buy trade, a W, because when you have a W, you're going to take a buy, right? So it's somewhere here and you went in for a buy here towards the reversal that happens at the New York session. Look at it here, 13 o'clock. So like okay, we waited, okay, and came first candle, second candle, third candle, you went in for a buy, boom, somewhere here you got out. This is even more clearer on the 5 minutes time frame. 5 minutes time frame is much more clearer. You can see that much more clearer. New York session reversal happened, a buy trade, buy trend, take a buy trade, W formation, and you made your money for the day. 300 points, 500 points, you're okay, you're out of the market. That is it. That is it. And with those tools and with those knowledge, your trading becomes easy, determined, no longer a guesswork, because you know what happens in the market every day, market sessions. You know when the reversals may occur because you're using the ADR, and also you're also using the trend. You get, and with that, you are good to go. So that's all for now. And if you don't get my explanation, you can always tag me up, my students, and I'm going to make a special video, or maybe we'll have a special material for you that you can use, and I can also explain up more in the charts. And let me know what you think. You can comment on this, you can subscribe. Don't forget to subscribe to the channel, make a comment. Let me see the areas I need to add more content, more material for you to work on. And with that, we are good. So thank you for the time. Don't forget, go for knowledge first, and the result will be easy trading, easy money, easy profits. So this is Bami Daily FX. I'm Bami Daily by name. See you next time. Have a successful trading journey.